After a big slide in the markets, investors are wondering, do I buy the dip? To help assess the possibilities, we bring in Yahoo Finance's data and markets editor, Jared Blikre, with the data perspective here. Jared.
Thank you, Brad. And set your stop loss orders. Check your VWAP. We've got some technicals to analyze. No doubt, there was a lot of fear during Monday's unwinding, but the S&P 500 is only down 8% from its mid-July record high. The big question on every investor's mind is, are we going to bounce from here? Now, the NASDAQ and the S&P 500 have declined into an area called the 200-day moving average. It's fairly simple to compute and describe. You take the average of the prior 200 days and plot it on a chart of market prices. You're going to notice that price moves around the moving average. So just give me a minute here. Here's the here's the NASDAQ. Here's a year-to-date chart. And on top, I'm going to plot the 200-day moving average. And you can see it's a little bit above here. But if I put on Candlesticks, which shows intraday price action, you can see yesterday touched that line exactly and moved off of it. And then if I show you the Russell 2000, for instance, a different market, you can see how price is largely above it. Sometimes it goes below it. And you can also see this with the Dow as well. Now, a lot of times price is going to catch up to the moving average line. And when it does, you might consider, all right, that's a mean reversion when the price goes too far too quickly. It tends to snap back to the average, and traders look at other time frames too. The 5, the 10, the 20, 50, and 100. Those are all settings that traders use. So here we have the 50-day to look at. It moves more quickly than the 200-day, and sometimes the two averages are going to cross. And let me show you what that looks like. So here's the 50. You can see it's moving a little bit quicker, that purple line right here, in relation to the 200-day, and sometimes they do cross. You're not seeing it here exactly, but let me show you a longer-term view. Here is a 2-year, and when they cross like that, it's called bullish. When it crosses like that, it's called a golden cross or a death cross. So putting it all together, traders will look for the slope of the line, and if it's moving up, they might look to put in a trade on it off of one of these averages. Short-term traders are going to look at the 5-day moving averages, and some of the longer-term traders are going to look at some of the longer ones. But all in all, just another piece of the pie to help you navigate these tumultuous markets.
Jared, thanks so much. Excellent breakdown. Certainly appreciate it. Yahoo Finance's own market and data editor, Jared Blikre.